Have you ever wondered who really controls the money in your pocket? It's not just the government. There's a much more powerful and often invisible player in the game: central banks. Let's pull back the curtain on how these institutions quietly became the puppet masters of global economies. It all started with a simple, recurring problem for governments. They always needed more money, especially for wars. Historically, kings and rulers would just clip coins or print more cash, but that led to hyperinflation and economic chaos. People lost trust in the money. The solution? A central bank. This new type of bank would be the government's lender, but with a catch. It would operate independently, tasked with keeping the currency stable. The first major player was the Bank of England, founded in 1694. It was created to fund a war against France, and in return for a massive loan to the government, it was granted the exclusive right to issue banknotes. This was a game changer. Suddenly, a private institution, not the government, had control over the nation's money supply. This model was so effective that it spread across the world. In the United States, the creation of the Federal Reserve in 1913 was a pivotal moment. After a series of financial panics, a group of powerful bankers met in secret on Jekyll Island to draft a plan for a central bank. Their proposal became the Federal Reserve Act. The Fed was designed to be independent of political pressure, with its governors appointed for long terms. This independence is key. It means they can make decisions about interest rates and the money supply without needing approval from the president or Congress. So, how do they exercise this control today? Mainly through interest rates. When a central bank, like the Fed, raises or lowers its key interest rate, it creates a ripple effect. Lower rates make borrowing cheaper, encouraging spending and stimulating the economy. Higher rates make borrowing more expensive, slowing things down to fight inflation. They can also buy or sell government bonds in a process called quantitative easing or tightening, directly injecting or removing money from the financial system. These tools give central banks immense power. Their decisions can determine whether you can afford a mortgage, whether businesses expand and hire, and even influence the outcome of elections. They are the unelected architects of our financial world, operating behind the scenes, shaping our economies, and, by extension, our lives. Thanks for watching.